Welcome everyone to our webinar. We have so far Kate, Mohan, Monty, Jerry, Arthur. Welcome everyone.
Hello.
Hello, how's it going, Kate?
Good.
Now you've been on a few webinars in the past, correct?
Yeah, then I missed some. This is after a while. I was out for a while, so I missed a few.
Okay, great. Well, welcome back. If anybody else has a microphone, would like to say hello, would love to hear your voice. We'll give people a few minutes to join in here and then start our presentation. How's it going, Jerry?
Good, Jason. How are you?
Doing good. Doing good. Trying to figure out what the heck Trump's going to do next.
Yeah, it's crazy stuff going on.
Sure is. Ron, welcome. Let me unmute Ron. How's it going, Ron?
Hey, I'm doing great.
Excellent. Yeah, wild markets. Okay, we got a few new people, a few more people coming in. Welcome, Marvino. I know you've been on a few webinars in the past. Welcome back. Monty, that sounds familiar. I believe you've been to a few as well. Dan O'Connell, welcome to today's webinar.
Hello, how are you?
Doing good. How are you doing?
Not too bad.
Good to hear.
We're getting a lot of curveballs out there.
Yeah, you know what? Who knows what they're going to do next here, huh?
Yeah, absolutely. Am I it today?
No, we have a lot of people in already, so I've been
Okay.
welcoming everybody. We have Dan, Ronald, Arthur, Jerry, Kate, Marvino, Mike, Mohan, Monty. Dean made it. Welcome, Dean. It's Dean's birthday, everybody.
Happy birthday, Dean.
Hey, thanks, Dean. Thanks, Jason.
So if you're not a member yet, today is the day to join and give Dean a birthday present. Only kidding. We only want you to join once you're convinced this is where you need to be. A few people I have never seen in here before. Broader, welcome. Broader, if you have a mic, please feel free to say hello. We'll get everything going in a moment here. As we give people a few minutes to get in. Anyone have any questions before we get started, just off the top of your head?
Jason, just the TLT is sold off so much, and you're thinking it's going to go lower, obviously.
Yeah, so I think we have a short-term opportunity to profit from a down move in the TLT. And so we've done that, actually. We did that a couple weeks ago, and the inverted option caller is very lucrative when you can bet down on an asset. But like I've said, the financial system's not engineered for these things to go haywire, and 90% of the time they don't. So, we'll be very short-term play on the downside of the TLT. Let's see, we got Karen in. How's it going, Karen?
Hey, I just ran in to get and I'm a little late on the alert, so I'm trying to figure it out. Yikes.
Yeah, okay, cool. Well, I can review it for you a little bit later, but we
Okay.
rounded down the GDX to an even 200 lot instead of 250, and then did the inverted option caller on both the TLT, GDX. I would suspect we have at a maximum 4 to 8 weeks where we can play a short-term pullback in those assets. And that will be potentially with a short 4 to 8 week opportunity to catch some big gains in the equities market. And that's with Trump bending over backwards and taking it. So, so if you're on the anti-Trump crowd, I'd say this is definitely not a win for him, although I know the stock market will love it. I think all the China hawks are going to be outraged. So we'll have to see what kind of tweets come out of Kyle Bass in the next week.
Hey, Jason, just one more question on the TLT. If since it's you're thinking it's going down with the inverted option, wouldn't it? Do you ever consider just standing aside and waiting for it to play out, or?
Well, we actually do really well on the downside, so I'll definitely cover that.
Okay.
On the upside, the profit loss chart that's the best. That's as good as it gets. But if you've seen a lot of those big testimonials from Kirk Wells, who is pulling 5-8 grand a pop on the TLT, that was actually from the identical trade alert we just did today in terms of the structure. And so on the downside, we actually can make more than that profit loss graph would indicate, because the put option has time premium left on it. And we got some new people joining in. Welcome, Ron, Laugh1153. If anyone does have a microphone and would like to chat, please go ahead and feel free to unmute it.
Yeah, great question there, Ron. With the way the options are engineered, we can actually make more money when it drops with callers. But
The only thing I think about too is it's fallen so hard so fast that it's due, I would think, for a short-term bounce.
So yeah, well, I'll cover that for sure, Ron. You got to realize TLT is not it's nothing like a stock. Okay, so TLT is nothing like the SPY or the emerging markets or GDX.
right.
It's an instrument that's highly sensitive to changes in interest rate.
Okay.
And so the big picture is that, I'll jump into that in a minute. I don't want to confuse all the new folks hopping in here. All right, guys. Well, we're 5 minutes past the hour, so I'll go ahead and start up a small presentation and then open it back up for question. And we have a mixture of customers and of potential customers. So this will be great. You can hear some real life questions from people who are in the program. And then also, if you're new to the program, you've just been watching, you'll not only get to hear my answers to your questions, but you also get to see kind of a broad variety of questions today. All right, so let me quickly, looks like we're all muted up. Okay, great. So I'll go through a quick presentation, review how the strategy works, what I see happening in the upcoming months, and how this applies to our portfolio. And then we'll open it up for Q&A. So we do have 15 people live so far, and more people keep hopping in. So thank you again for your time. And my goal after this webinar is to teach you how our strategy works, teach you why it works, and then prepare you to actually follow the program with real money. Okay, so it's a very simple strategy. Most people, whether we're winning or losing, they're able to get nearly identical results as our portfolio. And that's what's really important. Okay, so daily income trade alerts at noon Eastern. These are delivered Monday through Friday at a set time. We don't trade the portfolio outside of these trading times. And what that does is it makes the advisory very easy to get the same results that we publish. Now, in the last decade of doing this business, this was actually one of the biggest problems most people had. Is number one, they didn't know when trade alerts would be issued, so they could not live the lifestyle that they wanted to. And quite often would actually miss out on trade alerts or not be able to react to them quickly enough. And so you end up getting a much different result than what the so-called advisory is reporting. So that was one big problem. The second big problem was that it was unclear exactly how much capital should be used in each trade alert. So some of the worst tricks I've seen from other advisories out there were really two dirty little secrets they would do to inflate their returns. So if you've ever seen those ads that go out there bragging that they've never had a losing trade, well, the con in that advisory is that they take all the losers, they sweep them under the rug, and they never close them out. So if they never close it, they can say, oh, well, we've had a 100% win rate. Similarly to that same sort of con was another guru who I won't name, but he's out there selling his advisory for $5,000 a year, bragging about winning championship after championship in these different options trading competitions. I'm sure a lot of you guys know who I'm talking about. And his secret was that he wouldn't give you a position size. Instead, he would look at simple moving averages to pick direction, and he would just crank out trade alerts on specific stocks until the market direction would change. And then to make up for all the losses that you would suddenly incur when the direction did change, he would just ramp up even more trade alerts the opposite direction. So for his P&L, it would look great, but it would basically assume you had an unlimited account size. Now, obviously, that doesn't work, and you end up broke or bankrupt when you follow a program like that. So with our strategy, we've removed all those problems. You know exactly how much to own of each asset, and you know exactly when the trade alert will be released. And so this allows you to plan your schedule accordingly and to know exactly what's going to occur in the future in terms of what will be traded when. And so currently we're trading the SPY ETF Monday, Wednesday, Friday. It's a unique ETF that has 3 option expirations per week. It's the most highly traded security in the world. And really it's the bread and butter of our entire program. Because it has 3 option expirations a week, we can sell call options every 48 hours and then buy cheap downside protection. And when you realize you're in a massive bull market, not just a 10-year bull market, but really a 40-year bull market, that we've had a period of lowering interest rates with, sure, 2 major crashes and maybe a 3rd minor crash when you look back for the past 4 decades. But we're coming to the end. We're getting to the end of the punch bowl where the Fed can keep lowering rates. Where's the bottom? Well, probably around 0%. They're talking about even maybe going into negative territory. But this fun and games of being able to print money and lower interest rates and inflate asset prices is most likely coming towards the end. And so that's why it's so important to take advantage of the SPY ETF, to sell call options for income, but also to spend some of that income to buy downside protection. Because we're not just in a 10-year bubble. This is really a 40-year bubble. And when we look at the path of the federal funds rate, you'll see that this has been a long-term push to the bottom in terms of interest rates and creating new supply of money. So that's the SPY ETF, Monday, Wednesday, Friday. It represents the bulk of our equities portfolio. Now on Tuesday, we are aiming for extra risk and extra return. This represents a smaller piece of our portfolio, and it's 200 shares of the emerging markets ETF. Now what's in it? It's actually 1,000 companies spread out primarily in Asia. 2 of those companies are in the top 10 most profitable companies in the world, which are Alibaba and Tencent, 2 gigantic companies in China that have the subsidies from the entire tax collection of all of China. So they have some very unfair advantages in the world and have been growing at rapid pace. Now, on Thursday, we're playing the TLT ETF, which everyone has been asking questions about this morning. That is a ETF fund that owns a basket of 20-year plus US Treasuries. And you'll see the goal of the TLT is to provide balance in our portfolio and to help create very consistent returns with low volatility. And so you'll see when we go through our track record, how we've been able to pull that off. And once I go into some of the real meat of the presentation, I'll be able to visually show you the relationship between the SPY and the TLT visually, so that you can see how often the TLT comes in handy when unexpected sell-offs in equities occur. And then meanwhile, the last piece of the puzzle is our GDX, which is the gold miner ETF. When you realize you're in a bubble where all the central banks are lowering interest rates, printing money, we do want to be long gold. So much of the year we were playing GLD, that's the spot price gold, but after we reached very high price per ounce on gold, we did rotate into GDX. Our target return is 1% per month. And although we don't hit 1% every month, our average over the past 11 months is 1.35%. Now, that's not trying to outperform anyone in the advisory business, that's for sure. Most advisory services I've ever seen are out there pitching much higher returns, 3, 4, 5, 10% a month. They're looking for 100% gainers, 1,000% gainers, highly speculative. And what I've learned in the past decade of being in this industry is that most people who are buying these alert services or advisories really have no business trading such speculative assets. And what they really needed was something safe and sound to protect their nest egg and try to pull off easy, safe profits from the market by just getting the big picture correct. So the goal of this webinar will be to try to teach you how we evaluate what the big picture is and how that will influence our very simple 4 ETF portfolio. Here's a look at the returns we've had to give you a feel for how well this strategy works in terms of being able to reduce volatility from the markets. So the most notable examples, December, when we had a 16% sell-off, our portfolio returned 1%. If we look at January and February, the stock index went up something like 16% during that period. Who would have guessed? We're not trying to predict the exact movements like that, but because of the SPY and TLT relationship, we were still able to pull off very healthy gains, 2.2, 1.7. March, April, market went higher. We did not outperform the S&P 500, but we still came in with very nice returns, 2.7, 1.2. And then out of nowhere, there was massive profit taking. And in May, the S&P 500 sold off 7%. But what happened with our portfolio is our put option on the SPY kicked in, and that scare in the market sent a lot of money to the bond market. That's when the TLT gave us a nice win. July, equities flew higher, 7%. We did not outperform the S&P 500, but we did make a great return, 3.2%. And over the past 4 months, we've been playing it extremely defensively. I've been highly skeptical a U.S. trade deal would occur, and so we've been playing it very safe. We've been loaded up on defensive positions, puts, everything under the sun you could do to safely protect. And so in July, they came out saying we have a trade deal. That was our only losing month. We were very defensive going into July. And then came August, and surprise, surprise, he decided to announce December tariffs and October tariffs. Then a month later, or a month and a half later, we're back to, oh, everything's great, and we have a trade deal. So it's been very confusing, very hard to predict which outcome will play out. But regardless, you can see the S&P 500 has volatility in August of 7% and in September of 5%. Despite that volatility, our portfolio has had a relatively smooth sailing 0.2, 0.3, and 0.8% return. And again, our simple 4 ETF portfolio is extremely diversified. The SPY is 500 companies. The Emerging Markets ETF is 1,000 companies. So just because it looks so simple, realize you have a very complex index of the most profitable companies in the world. Now, we don't have a lot of exposure to Europe, but we do in Asia and the US. The GDX ETF has 50 plus gold miners, but what's more important is that most of that capital is allocated to around 5 mining companies who actually have the cash on hand to get the old barbellic out of the ground and sell it while these prices remain elevated. And again, our program is not trying to outperform any other advisory, and it's not trying to outperform the S&P 500. And when you do that, that's when you find yourself in a heap of trouble. Instead, I will promise you the exact opposite. When times get tricky, our promise to you is we will play it safe. We will always be defensive and skeptical and precautious and not hopeful and speculative. And so our goal is to simplify your portfolio, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And a little bit, we'll be looking into the future. I really have 2 base cases for what can happen. And at the end of the day, we end up popping both of these bubbles, regardless of which outcome. So let me just take a quick look at some of our recent trade alerts. And real quickly, I'm going to pull up this. Now, even though we are most likely going to be staying with that exact setup of ETFs for most likely the next 2 years, it's important to note that we use the options market to protect our positions and in some cases profit from a downward move. So right now on the equity side of our portfolio, we're bullish. We have a loose options collar, and that means we're selling a call option well above the current trading price. And then we're using that call option to finance our downside protection. So we're essentially getting free crash insurance on equities by selling a call option. And in this example, of course, we're way above 300 on the SPY now. But back when this screenshot was taken, you can see the SPY was at 298. We sold a call option $3 above, and we bought a put option $3 below. And so the maximum gain over this period would have been $3 a share. And on the other hand, the most we could lose would be $2.90 a share. So it puts a lot more comfort in your portfolio, knowing that anything could happen. Even an atomic bomb could go off, and you would walk away with $2.95 a share on the SPY because you took the time to buy that put option. Now, most recently, after we got above the 305 on the SPY, I've been tightening the option collar. So we've been waiting to see if this trade deal would really come through, although we've seen the US saying they seemed quite amicable to a trade deal. We have been seeing China start to demand more and more and more. And so far, the US is playing along, and the narrative is that we will have a trade deal. But we've been playing it safe. So in this example, you can see we've tightened the option collar. And this gives us a setup where we break even if it goes down slightly, and even can make a little bit. But if it trades flat or up, we walk away with $1 per share. And on the downside, if anything went wrong, we'd only have $1 at risk. So this is our tight option collar. When prices are getting elevated, but we're not ready to bet down yet, this is the classic trade we like to use. So we've been using this on the SPY for the last few weeks, being able to safely generate profits on this move up in equities. Now here's the trade we rarely do, at least in this period of time, but we have done it on the TLT and SPY a handful of times and have generated some larger than normal returns. And so This is the profit loss you would have holding all the way through expiration. Now in our program, we are getting out of the positions with some time premium left. And all that means is our put option could be worth a little more than this indicates when we close out the position. So we actually have done well with this bearish inverted option collar a handful of times this year on both the SPY and the TLT. So this is our current trade alert profile on the TLT and GDX, and something I suspect we can do for the next 4 to 8 weeks at a maximum as we watch this trade talks really play out. Now, if the trade talks start to backtrack and get delayed any further, we will certainly reverse the inverted option collar on the TLT. But in this case, we're selling the call option below the strike price. So you can see the SPY in this example is trading at 298. We're selling the in-the-money call option and buying the in-the-money put. And so this allows us to own the asset, finance a very valuable put by selling an in-the-money call. And so we can actually profit from a downward move. And so this is our setup on the TLT and GDX for this week into next week. So let me show you guys how simple the trade alerts are to follow, and then I'll jump into really the meat of the presentation in terms of how we pick direction and then create these trade alerts. Okay, so first of all, it's important to realize we do follow a strict schedule, and we won't trade these positions outside of that schedule for any reason. Now, could we optimize it by being a little more active? Sure, but that would ruin the selling point that this is a very passive and safe strategy that you can count on only trading at noon Eastern, Monday through Friday. So that's one rule that we will never break. You're only going to trade the SPY Monday, Wednesday, Friday. You're only going to trade emerging markets on Tuesday. And you're only going to trade the TLT and GDX on Thursday. So that makes your life very simple. Let's take a look at some examples of trades so you can see how you get into it and out of it, as well as how to read our trade alerts. Okay, so in this example, we're looking at the November 4th trade alert and the November 6th trade alert. So this will show you how we get in and out of a SPY trade. Now, what I do for you is the accounting work to audit the return over the most recent period. You can do this yourself. What you want to do is first note what was the price of the SPY when you entered the trade. So at noon Eastern, when we entered this trade, it was 305.52. Closing it out on this date, it had traveled to 307.54. So that's a $2 gain on the SPY. Now, because we had the protective option collar, we spent 32 cents protecting the position. And to get out of the position, we had to spend another 68 cents to exit that. So we lost $1 of our profit. And this was again on that tight option collar that will give up a lot of the upside potential to have more downside protection. And remember, going into this trade alert, we had a positive narrative in the trade deal, but China kept increasing its demands. So we didn't know whether or not the US would bend over backwards and take the deal or not. So it made sense to play it safe. Okay, so I'm going to scroll down and show you the actual trade. So in this case, the put option expired worthless. And I also do want to point out that you do get the trade alert instructions sent to you via text message. A lot of our members actually take these trades from the airport, from restaurants while they're on vacation. So they do like being able to get a simple text alert and be able to easily follow the trade alert. It takes a couple minutes and then they're done. So in this example, we had to close out the previous week's trade, buy to close the short call, and then we allowed our put option to expire worthless because, as you can see, the SPY did go up in value. So the put option lost its value. And the next trade was to roll over the position. So in this trade, we sold the 309 call for a credit of 35 cents, and we bought to open the 307 put. Okay, so let's see what happened from the 4th through the 6th and how that was followed up on yesterday. Okay, so we jump to the next trade. And you'll see the accounting. So it's showing that the SPY went from 307.54 to 307.05 for a 49-cent loss. Our option caller, we paid 30 cents to enter, which you can see right here, the net debit. And to exit the trade, we actually were able to collect 27 cents back from the option caller. So the net return on this was 52 cents, but the catch was our TLT position jumped by 80 cents. If we scroll down to the trade alert, you'll see the text message sent summarizing the trade, so you can take the trade on the go. In this case, the put option did go up in value, so we were able to buy to close the 309 call and then sell to close the 307 put for a credit. That exited the trade. And here's our current trade alert, which has hit the maximum profit because we're above 308. We sold to open the 308 call option expiring November 8th. That's tomorrow. And we bought that 306 put. In every trade alert, you'll get the risk graph so you can see what our best case and worst case scenario looks like. So that's how we get in and out of the SPY trade. That one's happening Monday, Wednesday, Friday, very consistently. I did see a new fellow just jump in. Chuck, welcome to the webinar. Okay, let's take a look at another set of trades. So you're going to see they're very similar in style. This is our Tuesday trade in emerging markets. You can see the format's the same. Up top, we will tell you the change in price of the ETF from when we entered the trade and exited the trade. Next, we'll account for the cost to create the option caller and the cost to exit the option caller, and then your net result. And you scroll down below, and you can see the trade alert. So in this example, we had to buy to close the previous week's call option and sell to close the previous week's put. The next trade was just walking up those strikes as we're anticipating the emerging markets ETF to travel towards 52 on a good trade deal. And we've been playing emerging markets for quite some time now. And so you can see we sold the 44 call and bought the 42 put. And so once again, you get your risk graph so you can see the maximum gain or loss for the trading period. So then we can jump to the new trade, and you'll see that we went from a 42.80 on emerging markets up to 43.81 for $1 profit. But again, we had that protective option caller. We had to spend 11 cents to create the protection on the option caller and another 17 cents to exit. So we did give up a portion of our profits. The net profit on this was 63 cents. And so we can scroll down and look at the trade. Once again, in this case, the put option lost its value. So we only had to buy to close the call option. And then you can guess what we did next. We moved those strikes up slightly, and we sold the 45 call, and we bought the 43 put. So had the trade deal broken down this week and emerging markets crashed down to $30 a share, it wouldn't matter. We would still walk away with $43 a share because we bought that put. All right, now the last example is the TLT. So we'll take a look at that. This is going back to the 24th through the 31st. And you can see once again, the format's exactly the same. First, we track the change in price of the asset. TLT went from 139.80 to 140.10 for a 30-cent gain. Our protective option caller lost 27 cents to put the trade on, and we got 2 cents back closing it out. So we essentially broke even on that trade. Scroll down, we'll see the trade alert. In this example, we would buy to close the call, sell to close the put. That closes out the previous week's trade, and we rotate to the next trade. Sell to open the 143 call, and buy to open the 137 put. If we jump to the next trade, you can see we track the change in price of the TLT, jumping from 140.10 to 141.37, $1.27 profit. The option caller lost 21 cents. We get you your net profit. Scroll down, you can see how to place the current trade. This would have been last week's trade. Now in this example, the put option lost its value, so we allow it to expire worthless. All we need to do is buy to close the 143 call and then sell to open the next round. So we sell to open that 144 call and buy to open the 138 put. Now with the news this morning, with US saying they will roll back tariffs to get a trade deal at all costs, our put option actually kicked in. So TLT is somewhere around 135 as of this morning, 135.50. And we were able to get 138 a share because we take the time to buy downside protection. Okay, so that is in a nutshell how the program works. You've seen the returns we've generated. Now let's talk about the strategy. How do we really make the market calls, and what do we expect happening in the future? And so once again, I do want to show these 3 slides. Although the ETFs will likely not change much at all in the next 2 years, the option callers can, and that's how we can profit in different circumstances without having to change your underlying assets. This makes it very easy and consistent for you in terms of knowing what we're going to trade, when we're going to trade it, so that you've done your homework, you know what assets you have in your portfolio, and you understand why we're trading them the way we are. So again, if we think the asset's traveling higher, the bullish loose option caller is the way to go. If we think the asset is most likely trading flat or up, but there's a risk of a sharp sell-off, the tight option caller makes the most sense. And typically only after a catalyst has been created to give us a real move to the downside will I issue an inverted option caller. So an inverted option caller will profit from a down move in any of these assets, and that's simply done by owning the asset, selling an in-the-money call option, and then buying an in-the-money put. So we've had very few opportunities to issue this trade alert over the past 11 months. We'll talk about why, but we did just do this for both TLT and GDX today. Okay, so let's look at the big picture, what I expect is going to happen, and how this all plays out. The easy way to predict markets and generate safe income. Okay, so there's really 3 core things that I'm focusing on to design our portfolio. Number 1 is whether or not the Federal Reserve is buying or selling assets. And in this case, they are buying. They've bought up $260 billion in treasuries and mortgage-backed securities in the past 2 months. So that is nearly the same pace that they began with in 2009 after we'd had a huge stock crash. Now, the Fed's been pretty good at predicting stock market crashes. Their hint is they start cutting rates before it happens. What they've not done in the past is start up the printing press until after the crash has occurred. So this case is a little different. They were predicting a stock crash or the potential of a stock crash. So they've aggressively dropped interest rates 3 times this year. But rather than wait around for the crisis to hit, they've actually began purchases to the tune of $60 billion a month, plus an overnight repo of $190 billion. So their balance sheet is growing, and this is the same as almost all central banks around the world. In fact, there's 23 central banks expected to cut rates in this quarter alone. So that's the first big thing we want to track, is whether the Fed is lowering rates or increasing rates, and if they are buying treasuries or selling treasuries. So right now it's clear they are buying treasuries, and they have lowered rates 3 times in the past 6 months. Okay, now this is the picture that you really need to pay some attention to. So we're in a 40-year bull market since the handover from Paul Volcker to Alan Greenspan. So we went from a period of hiking federal funds rate to as high as 20% during the inflation of the 70s to the exact opposite. Now we've been in a period of gradual rate decreases for the past 40 years. Now the problem here is you can't really go below 0. You go below 0 and it's going to flip the entire credit system upside down. Now there have been some central banks getting away with some negative interest rates, but that's with a positive outlet to positive yielding bonds in the US. So my expectation, and we'll look more at the reasons why, is that the Federal Reserve, without nothing short of a miracle, is going to be forced to slowly but surely drag its feet and drop these interest rates all the way to 0. And that's when they're going to officially run out of ammunition. Now, if we do look at how they got out of the last 3 crises, so we got the 90s, the 2000s, and the 08 crisis, well, you can see in order to protect against a long-term depression, they had to cut interest rates by an average of over 5%. And so that's a dramatic change in the flow of money. But this time around, there's not that much room. In fact, if they wanted to drop interest rates by 5% this time around, we would have to go to a federal funds rate in the negative 2.5% range. So that is why they're freaking out. They know they have very limited ammo in terms of rate cuts, and they're trying to delay this with massive asset purchases. Now, if you listen to Ray Dalio, one of the core people I do study, and our portfolio is very highly correlated to his portfolio and Stanley Druckenmiller's, we realize that we're running out of ammo. So this chart right here is likely to reverse course over the next several decades. And we're getting towards the end of the parade of being able to enjoy low interest rates and increasing the monetary supply. So what actually makes the Fed change its protocol? And the funny thing is, it's something that we already have plenty of, and it's inflation. Now, if you look at their numbers, the CPI is very low right now, 1.7. And they are all about trying to make symmetrical 2% inflation. In fact, now they want to go over 2% to make up for all of the slack in inflation they've had. So all that really means is their promise to society is to make the value of your dollar lose at least 2% of its purchasing power per year. Now, you might think, why on earth would they want to do that? But if they didn't, everyone would suspect that they'd be better off holding on to their money so that would grow in value, and that can crush the whole economy. So that's the whole reason behind this magic 2% number. But the trouble is that slowly but surely adjust their CPI formula to keep it artificially low. And when we look at what real inflation is at today, we can see they should have already been jacking up interest rates long ago. So we are at the whims of these mad central bankers who are trying to delay the inevitable. And if we do look back at most of these very nasty periods of time from World War I, World War II, we've got the really awful period of time from 1965 through 1980. It's been inflation that really ruins the party. And so I'll jump into my prediction of what will happen in a minute. Let's take a look at a few things here next. So right now we have a pretty clear projection of what's headed our way. Most likely lowering interest rates, continued quantitative easing. And so this is going to be, in general, bullish for both stocks and bonds. Now, I would argue the bond market was preparing for a trade deal breakdown, and now that's why we're seeing such a sharp sell-off in the TLT. But in general, we can look at the relationship between the SPY and the TLT to get a feel for why this strategy works so well, why it's so popular. And so in the orange line, you have the TLT, and the green line is your SPY. And all I want you to really look at is that in general, both of these assets have gone up in value. But when the SPY has sharp sell-offs, and we can look at the 2008 crisis, that was about a 50% sell-off. Well, what happened to the TLT? It shot up by about 50% in value. Okay, then we have another sell-off in 2011. What does a TLT do? It spikes up. We have another sell-off 2015, TLT spikes up. You get another sharp sell-off at the end of 2018. What does the TLT do? It spikes up. Okay, so that's a critical relationship that makes our whole financial system work. And by simply having a relatively even ratio of those two assets, we can dramatically reduce volatility in our portfolio. Now you add in our option callers and you can grind down volatility to almost nothing, which is what you've seen in our returns. Here's a look at just the TLT. And again, you can see these sudden spikes in the TLT line up perfectly with pullbacks in the S&P 500. So if you're in a period of life where you're done with these huge swings to your portfolio, you're tired of 5, 10, 15, 20, 50% drawdowns, the TLT does a lot of that value for you. Now, here's another example. Looking zoomed in at the 2009 crisis, we can see in the orange line, S&P 500 went down as much as 50%, and TLT went up by about 38%. Now, keep in mind with our strategy, you wouldn't have lost 50% on your SPY. Most likely, we'd be doing the inverted collar. But even if we had been bullish, your put option would have kicked in and the TLT would have rallied. So that's why you see in our track record that every time stocks sell off, we're able to limit those losses and then catch a big win on the TLT. But in the same breath, in general, when the stocks do travel higher, the TLT is not getting killed. And so you can see during this period, the TLT went up 26% and the SPY went up 42%. But every time there was a sell-off in one, the other rallied. Now here's another example where the SPY went up in value by 51%, but your TLT by the end of that period had only lost 2%. So it provided that protection without really hurting our profits had we had this simple strategy in place there. And you can see the same relationship through most periods of time. So what I'd like to do now is jump into what's going on in inflation. So the big question is, when does the long bond stock strategy break down? Because that's when we will have to dramatically adjust our options to protect us from that. And so the answer really is when the central bank decides to end quantitative easing and rise interest rates, that this strategy can break down. And usually the only reason they will change policy is if there is runaway inflation. And so the periods of time that investors need to be really concerned about, I would argue, is 1965, which is right here, through 1980. So that was a 15-year bear market for both stocks and bonds. We saw the federal funds rate during this period travel to 20%, which is absolutely astronomical. And during this period, we saw stocks crash from 7,500 down to below 2,500. So that is the type of move we may be headed for once the central bank gets to 0% and is out of ammunition to continue lowering interest rates. Because most likely inflation will eventually start seeping into the economy. Now, right now, most of the inflation is stuck in stocks, in bonds, in real estate. But we've also seen an extreme increase in rent, medical costs, and college costs. So sure, we can produce your cheap little goods a lot more productively than before. The Amazon effect is increasing productivity. There's certainly been a lot of productivity gains, but whichever industry the government has come in and guaranteed, like the housing market, like the college education market, and like the medical market, we've seen massive levels of inflation. Here's a look at the federal funds rate and the inflation rate. And so right now you can see we are in this period of lowering interest rates and low inflation. And it's only these spikes in inflation that have created serious long-term downturns in the market that we're really looking out for. And so what does the Fed do when inflation does start to get out of control? In this chart, we can see the CPI in blue and the federal funds rate in red. And every time that blue line starts to park up, they jack that interest rate above. And so if we look at this period from 1960 through 1980, you can see they thought they had inflation under control after spiking the interest rate up, and then they would drop the interest rate down and inflation came roaring right back up. And so you can see that inflation coming down and spiking up and then coming down and then spiking back up. And so this gave you a 15-year bear market where being long stocks or bonds was not the answer. In fact, this was a period of time where you needed to be short selling the market. That's where our inverted option collar would really pay off. Then in the reverse, we have Alan Greenspan come in 1980 and do the exact opposite. He would drop rates and then raise them slightly and then drop them lower and raise them slightly until we got to Bernanke and then Janet Yellen. Now we have Powell. So what happens every time they jack up the interest rates? Well, you get your rare negative GDP print. It works like clockwork. Cut off the money supply, cut off the growth of debt. All of a sudden, GDP doesn't look so hot. And you think about the way the US is creating GDP, and China and most nations, is they go show off these growth numbers. But when you compare it to the growth of their debt, it's actually negative. We're growing debt faster than we're growing our GDP. So this can only last for so long. And once we realize if we can predict the path of the federal funds rate, then we have a good idea of where these treasury interest rates will land. And so certainly the federal funds rate is like a magnet for drawing the interest rates. So if we believe that the federal funds rate is headed towards zero and that we're going into a period of quantitative easing, we can get a good idea of where to bet on both the bond market and the stock market. Now the catch is, as soon as these mad bankers decide it's time to end the free money supply, that's when our whole strategy has to change. And so there's already plenty of inflation out there for them to be making that call right now, but they're not. And that's because they don't want to put the economy through a lot of stress before they absolutely positively have to. And so we can see there is massive inflation that they are quietly weeding out of their formula year by year. And in fact, if we just go back to the metric they used in 1990, we'd be near a 6% inflation rate. So the federal funds rate would most likely be spiked to above 6, maybe around 7, to get all the malinvestment out of the market and get all this funny money. All these companies are just losing money. The private equity market is the worst right now. They have massive valuations and they are losing money at record pace. And the only reason they can do that is because they can borrow at near zero to keep this madness going. And if we go back another decade, you can see not only is inflation near 10% by the measurement they used in 1980, it's in a clear uptrend. So we'd be back to Paul Volcker interest rates if they wanted to really fix the problem anytime soon. So when you realize that, and you know that we're now at the whims of the central bankers to flip the direction of interest rates and to stop the QE, you can realize how dangerous it is to own not only stocks or bonds in this current day and time. And so that's why we don't really worry about missing out on big gains in the market, trying to catch every last inch of it. We're much more concerned with a period of time that will most likely look something like 1965 through 1980, where eventually they have to raise interest rates and pop the bubble. And that's where you got nearly a 90% sell-off in equities over a 15-year period. So imagine 90% of your assets going down in value for over a decade. So that's the risk. And so everything is pushing on the inflation. We have minimum wages being raised left and right. If you listen to businesses, all they do in these different meetings with the Fed is complain about the labor shortage. They can't hire people without cutting into their corporate earnings. And we can see we're getting towards record low unemployment rates. So as the wages continue to push higher, that's going to become more and more a problem for this whole narrative of keeping inflation low. I'm just going to point through a few periods of time just to show you some more evidence that it really is the inflation that will ruin the party. And it's really when the central banks make the call. Now, I don't think the central banks, if you do read a lot of the books and the diaries of the central bankers over the last, really last 150 years, at the end of their life, they all joke that they felt like they did not make an impact on the end result. They just changed the timeline slightly. And so we go back to World War I, we can see a lot of inflation during the war, followed by deflation. This is while we were still on the gold standard. And this eventually led to the Great Depression from 1929 to 1939. This is where Ray Dalio thinks we are at right now. We're leading into, thinks it's something like 1927. So we're in the roaring 20s, stock market's flying up. We got malinvestment everywhere. Money is cheap. Everything's great. And then next thing you know, the world was putting reparations on Germany to the point they could not pay it. They had to experience hyperinflation. They invented new currencies. They did everything under the sun to try to pay off all this debt that they had incurred from the war reparation deals. And it ended up putting the entire world into a Great Depression. And so you can see that period of time with two crashes. So in the first, we had massive inflation. In the second example, we ended up with massive deflation. In both examples, we had some very nasty stock sell-offs. In the first, we went from 2,500 on the Dow to 1,000. On the second, we went from 5,500 down to 500. That is a massive 90% sell-off. And perhaps that is not what would be in the books in today's modern age with the advent of no gold standard. But regardless, it shows you what happens when prices get out of control. Next big period to really focus on is Cold War. This is what I personally feel like is more closely related to our relationship with China right now, although the opponent is substantially larger than Russia was during this period. And this lasted through many presidents. It had periods of peace and it had periods of escalation. A lot was happening behind the scenes that nobody knew about. And so let's take a look at what happened during this period. So these are your inflation prints. For the most part, we had relatively low inflation from 1945 through 1965. And it was only till 1966 through 1982 where we experienced runaway inflation. So what impact did that have on the markets? Well, sure enough, we have a massive stock market rally lasting really from 1947 all the way to 1965, going from 2,000 in the Dow to 7,500, only to be followed by a 15-year bear market where we had runaway inflation. And what did the central banks do? Well, they had to jack up the rates. So this is what all the big hedge fund legends from Stanley Druckenmiller to Ray Dalio to Jeffrey Gundlach are all predicting. We're in the last couple of years where we can get away with lowering the interest rates, printing money. You end up with inflation, and then you end up with a period of time where you have to work down these debts. And so in this period of time, they would jack up the rates, hope everything was good, create a recession, and then pull back the rates down only to be back to the same problem. And so you can see in each gray period a recession right after they had to jack up rates. So this is quite likely the environment many of you will be living through in your retirement. Now, what happened after that? Well, inflation became under control. All the malinvestment was weeded out, plenty of bankruptcies. And now you had to be smart with your money because you didn't have access to free capital. You actually had to make a profit. And this made another beautiful run in the stock market. Was there some volatility? Sure, but by and far, this was a long-term bull market that actually lasted for 39 years now. The problem is the magic sauce that allowed this long-term bull market to thrive is coming to an end. We really can't go below zero. And now you can see the market is hypersensitive to spikes in inflation. It's no coincidence that the last two market crises we had were when inflation barely popped above 3. So look at 2000, we hit 3.4%. Did the same tricks. It worked, but we were able to cut rates by 5%. 2008 did the same trick, but we had to actually throw in about $5 trillion of devaluation of the dollar this time. And now what are they going to do this round? Here's your central bankers during this period. And you can see they're running out of ammo. They can't go below 0. They can't drop rates 5%. So this time around, they'll likely cut it to 0 and do massive quantitative easing. But what happens when we do massive quantitative easing? We get inflation. So here's our inflation prints over the last decade. You can see they've been very under control, very low, but they're starting to perk up. So Jerome Powell, a lot of people thought he's going to be the hero for the conservative monetary policies. He was on autopilot just a year ago to raise interest rates and continue quantitative tightening. And my, oh my, how has Powell pivoted? He went from that stance to dropping rates 3 times this year and injecting $280 billion into the balance sheets just in the last 60 days. Okay, so let's look at some predictions of what might happen in the future and how this will play out in our portfolio in terms of protecting capital and trying to achieve our target of 1% a month. Okay, so I really have 2 base cases for what I suspect could happen. At the end of the day, there's 2 large bubbles to pop. One's in the stock market, one's in the bond market. The first scenario is the one where there's not pressure to expedite popping the stock market from China trade war or from the impeachment. And that's 2 really big hopeful ifs. And as you've seen, we've been playing it safe, assuming the trade war would break down and the impeachment would escalate over the past few months. And we were wrong so far. So far, the narrative is that we will reach a trade deal and roll back these tariffs. So until that was actually being confirmed by both sides, we've played it safe. So let's say this continues. What potentially happens? Well, in general, we're going to want to be long all of these assets. And although we are short the TLT right now, that's just because it did get a little bit ahead of itself. I will be very excited to get back long the TLT in a few weeks after all these prices readjust. But with an environment where we have central banks lowering interest rates around the world, printing money, this is the bubble of everything. This is where we want to be long our 4 asset classes with downside protection from the option caller. So how long could they get away with this? Most likely up to 2 years. So if they were to drag dropping interest rates every 3 months by 25 basis points, that would give us about a 2-year stretch before you hit 0. Now, what could give them even more time? Well, if the US GDP were to pop above 3% and they were to start to decrease the government deficit, then perhaps this could go much longer. But the catch is the only way we've gotten even close to a 3% GDP is by creating a massive, massive government deficit, $1 trillion this year. So either the central bank allows the yields to go up to a more natural rate, which would probably be around 4.5% at least, considering the real inflation we're living in, or they can artificially protect the credit market, which is what they always do. So they're really trapped. Unless the government really were to clean up its act and stop creating deficits, they are going to be forced to provide support to the bond market and try to keep everyone holding their bond position by indicating the intention to slowly drop rates and at a minimum not increase rates. So this is our current profile right now. Eventually, what you get is rising inflation. Now, we already have clear inflation. It's just a matter of when the central banks want to declare that it's a problem and start to raise the interest rates. So eventually, we will start to see their CPI pick up. They've told us they want it well above 2%. So during that period, once we get confirmation from their very own metrics that we're above 2 and have sustained over 2 for a considerable amount of time, that's when you get some serious problems in the bond market. And so this would most likely be the last hurrah for stocks and gold and a sharp long-term sell-off in the TLT. Now, eventually, we get the repeat of 2018 where yields become so attractive that the stock market has a nice pullback because money is flooding into bonds. And this will still be in the backdrop of inflation and now rising interest rates. So during this period, we would see a rebalance. Now stocks are at all-time highs, selling off. Bond yields are dropping as money floods into the bond market. And this will be the period when we also want to get out of our gold position. This potentially could be from 2021 through 2022. And then what happens after that? Now we're in a clear path of rising interest rates. We're already have reached the zero bound, so they can't do any more quantitative easing. And you get a period of rising rates and no quantitative easing. Now, if we go back to that 1965 to 1980 example, this period lasted 15 years, not 5, and it was in phases. So this period could last longer than 5 years, but I think not giving yourself at least a 5-year perspective for this period of time where we're going to be working down debt, we're going to be getting companies that have been losing money to go bankrupt, we're going to really be cleaning out the economy. This is a period where we're short both the stock market and the bond market. And now all of a sudden you want to have some cash in the bank because you're getting a huge level of interest. So that'll be a very simple strategy during that period and will be highly profitable. Very few investors are prepared for these conditions because over the last 40 years they haven't seen it. They don't realize that they can't use the interest rates to save the day any longer. And then eventually you get your reset. This is your Warren Buffett strategy. And in this setup, interest rates will be very high, just like we saw where Paul Volcker had rocketed them up to 20%. I don't see that happening in this day and age, but perhaps they get them up towards 5 to 10%. And then they go through a period of dropping interest rates and the promise of quantitative easing is potentially stimulating the economy. At that period, we'd actually get out of the SPY into a little bit better asset, the QQQ. And then instead of the TLT, we can go into LQD. So that's our best case outcome if we don't have a trade war with China that implodes on itself, and we don't have a political crisis where the House votes for impeachment maybe by February, and then we go into the Senate. So any of those two crises may change the outcome. So let's look at our other base case. How the bubble pops with pressure from China and with impeachment. Now this has been the case I actually believe is more likely. It's just timing. When exactly will these two events occur? And so they haven't happened yet. We've seen minor escalations with China, but nothing serious. And we've seen minor escalations in the impeachment, but clearly stocks are at all-time highs. The world is discounting these risks. So with a low rate, low inflation, plus QE, plus fear, how does this change? Well, we've already seen it. Every time we get the threat of tariffs, the threat of trade war escalation, it's been very negative on equities. Not for a long period of time, but for short periods of time. So in this environment, we would want to wait for a catalyst to hit and then be short the equities and long bonds and gold. So we still have a big asset bubble, but we're not going to be ready to be long-term bears in equities yet, and you'll see why. Next thing that happens, we get a sell-off in stocks, bonds rally to new highs. We're still in a period of lowering interest rates. We're still in a period of quantitative easing, but now we're starting to see inflation prints rise. Now you finally get the bonds, which have been overbought, to sell off and flood into equities, as equities will have already been sold off, and money is still cheap at this point. Eventually, the inflation gets above their 2% target for long enough that they start to raise interest rates, and they cut off QE. So then you get your 5-year period where you got to work down all that malinvestment, work down all the government debt, start to balance the deficits in the government, get rid of these corporations that are losing billions of dollars on borrowed money. And again, I'm giving us a period of at least 5 years for that to work itself out. And it could be longer. If we look at different periods of time, it has taken longer than 5 years. And the level of debt we're in right now is astronomical. The world government debt's at $266 trillion. So again, this is a period where we'd be short equities and then just simple buy and hold the dollar for high levels of interest. Eventually you get a massive sell-off in stocks and bonds, at least 50% in both, and we'll be at high interest rates. And you're back to the reset where both the bond market and stock market have reset, and we can go to a more aggressive strategy. So that's really the long and skinny of it. That's looking way down the road. For most likely the next several years, this will be our best setup, assuming that the trade war escalation doesn't happen in 2020 because of the election, and that the impeachment's just going to be more of a show that just gets delayed as long as possible. Nothing really comes of it. Then this portfolio, just like this, can remain mostly long and do extremely well. And the catch is, we have a few things that will end this strategy. One, once the interest rate gets to 0, we know that's going to spell trouble for the bond market. And then two, once we start to see inflation rising, they're going to put the pressure with rising interest rates. All right, so let me open this up for Q&A now and see what questions we have. And so let's see, we still have 13 people live with us. You made it through the presentation. Congratulations. Let's see what questions we have out there. Any questions at all? And I do want to point out, you can call Dean for a free portfolio consultation after this webinar. We can take a look at what you've got yourself into right now and how it would work with our strategy.
Yeah, and folks, please feel free to jump in. I know that was a lot of information in a short amount of time. But yeah, please feel free to jump in with any questions you may have. Anything in general, whether it's about the market or our system, or if you want us to go back through and explain something in greater detail, please feel free to either type in the chat box or simply unmute and ask your questions, okay?
And so while we wait to see if we have any questions, I do want to once again just show our track record and again repeat what our goal is. So our goal is to protect your portfolio from downside risks. Now, right now, we're sitting on a huge gain in equities and in bonds, and many people think that they can be protected by either one of those. But the problem is we're running into a period of time where the central banks cannot keep this 40-year market, this bull market in both bonds and equities going any further. And so once we get to that 0 bound, the game's up. And so in the last 11 months, we've done very good at having low volatility and delivering very safe returns. And most important to point out is the December crash, 16%. We generated a 1% return. In May, stocks fell 7%. We generated 2.2. In August, you had another 6% sell-off and we delivered 0.8. In the last 2 months, I really didn't know what was going to happen with the trade deal. I was playing it defensively and predicting something bad would happen. We didn't lose money being wrong, at least early, and we squeaked in some pretty small but consistent safe gains. So you got to ask yourself, what's going to happen next? Are we really going to have a rosy 12 months ahead where stock market goes to new highs and there's no volatility? Or is something unpredictable going to happen? And will you be protected? Okay, we got some questions. I noticed your position sizes were 1 or 2 contracts. On how small of an account will your strategy be effective? So yeah, that's a great question. And as long as you have $75,000, you can accurately follow the program with this exact setup right here. Now, do you have, most brokers will give you 2-to-1 buying power. So you're going to need at least, what is that? 37.5. If you deposit 37.5 to your broker, you should be able to fill this portfolio and be able to follow our full strategy. Now we do have a light option where you just trade the Tuesday, Thursday play, and then you'd only need 33,000. What portfolio do you have? At least 75,000 or at least 37,000 to follow the program, Ron? Not at one time. What about half of that? And let's see, Kate, I know you had your microphone. You want to unmute and chat with us a little bit before we wrap up today's webinar?
Yes, I see your, your plan. It's very good. I mean, I haven't tried it, but it looks good.
So Kate, tell me about your portfolio right now. Do you own equities?
I actually, if I do trade, I would probably trade in my IRA, but I don't have anything right now. It's all cash.
Oh, okay. So your IRA is in cash?
Yes, right now, yeah.
Okay. So you've been playing it safe, except we know that the central bank has one promise to you. What is that? Their promise is to deliver 2% inflation.
Oh, yes, yeah.
So you're losing 2% of your buying power right now every year by being in cash. So if you look at what we're recommending, here's when you want to be owning cash. Let me show you. You want to own cash when the central bank racks up interest rates. So right now, rates are almost at 0%. So there's not a lot of value in owning cash. And they're actually devaluing money at a faster rate now than ever before because they have printed $280 billion in the last 60 days and are on track to do $60 billion a month. So they tell us 2% inflation. We're probably living in something more like 5 to 10% inflation. So you're losing a lot of your money every year by being in cash. Now, does that mean you want to just go long stocks? Not necessarily, but the period of time where you want to have that cash saved to actually benefit you is going to be most likely 5, 10, 15 years from now when interest rates are being spiked up and that's causing the stock and bond market to pop. But right now, really the central bankers don't give you a choice. You have to go with what they're doing. Okay, Mike Sarvis says, as a retiree, I found that my expenditures are limited and not reflective of the bundle measure by the CPI. Well, that's very good, Mike. But regardless, in terms of trying to grow your portfolio, you got to realize we're at the last couple of years of this bull market at a maximum, and then these markets start to pop, and the losses can be disabilitating for someone in retirement because you don't have 5-10 years for your account to bounce back. You really need to protect every penny you have. What's your portfolio look like right now, Mike? Are you in cash, equities, gold? All cash. So once again, you're just not in a good spot to be in a cash position when interest rates are near zero and headed to zero. How long have you been in cash for? Forever not knowing what to do. Sure. It sounds like this is a good program for you because you don't like to lose money. You know we're in a massive bubble and you want the downside protection. So yeah, I think this is something that would make sense for someone like yourself. Do you have enough capital to build this portfolio right here? Okay, great. Now, what questions do you have, Mike? What's holding you back from? Are you just trying to get to know the program better? Are you concerned about not being able to follow the trades? You just want to know the program?
Nice. Thank you for that, Mike. And Mike, real quick, have you traded options before? Nice. Okay, and just kind of to go on top of that a little bit, have you ever traded option callers before?
Okay, well, yeah, if you can do an iron condor, you got this easy.
Yeah. And so, folks, I want to just read something really quick here from the CBOE of the Chicago. So the CBOE is the Chicago Board of Options Exchange. Okay. So that's the exchange in the U.S. markets that basically, handles the majority of the volume here. And if you go to their website and you search option equity callers, they have a little question here that says, who should use equity callers? Okay. And it says an investor who's looking to limit the downside risk of a stock position at little or no cost. Okay. Also, an investor who is willing to forego upside potential in return for obtaining this downside protection. Okay. And I think that's really, in essence, really what we do, for our investors, right? We're absolutely going to limit the upside a little bit, but we're at the same time, we're going to reduce your downside. And as Jason had pointed out, back in December of last year, the market sold off, almost 15%. We made money. This May, when the market sold off, 7%, we made money. A couple months after that, market sold off 5%. We made money again, right? So we're not going to outperform the market, as Jason said, by any way, shape, or form. But the whole thing is to preserve your capital. And if you look at any quarter stretch that we've had, we have not lost money, okay? And it's going to be really tough for you to go out to any money manager on the planet and be able to find that, okay? Now there is hedge funds that definitely have those type of results too. But most of them actually aren't taking money, and they're limited to how much capital they want to have in the fund. So just some things to think about here, guys. And really what we're trying to do is really fill the gap between the investors that don't have $20 million to go join a hedge fund that rarely loses throughout on a quarter-to-quarter basis, but that's something you can get access to here, and at a tenth of the rate that you're going to pay with the hedge fund.
Now, Mike, I just noticed I had your microphone muted. If you do have a mic and you'd like to speak out loud, we welcome you to say hi. What about Chuck Smith? Are you still listening live? Oh, Chuck just got off. Okay, Mike Matson. Okay, no Mike. Okay, great. So yeah, Mike, we'd love to have you consider joining the program. I think it's pretty straightforward. Right now, I think in the next 2 years, we'll be able to take a lot of the sting out of the market for investors. But I think it's after that, when you look 2, 3, 4, 5 years down the road and you realize we're at the end of the rope, that's when all of a sudden everything you know about investing is going to go out the window. And you're really going to need a program like this. And more specifically, you're going to want to understand this specific trade right here. Now, does this trade right here make sense to everyone? To Mike, do you understand this one? How that works? How we can own the asset and safely profit from a downward move? So in this example, we own 100 shares of the asset. That gives us the right to sell a call option, a covered call. Instead of selling it above the trading price, we're going to sell it below the trading price. That gives us essentially free financing to buy an in-the-money put. And when you have this set up and you go into a period where the Federal Reserve is going to have no choice but to slowly but surely raise interest rates for a long period of time, this is going to be the only safe way to profit from a collapse in the stock market and the bond market. And my best guess is that if the China trade war escalates, we see the stock market crash first and then the bond market. And if everything is hunky-dory and the central banks are allowed to keep on slowly lowering the rates and slowly printing money, then we'll have the opposite. We'll get the bond market in trouble once we get to zero, and then we see the bond market pop. So unfortunately, I'm sure you guys have listened to plenty of these legendary hedge fund managers talk about how the future outlook for returns is very dark, and that's because of this. They all know this is the chart that really should keep you up at night. Once you realize this means we're at the end of the rope, we can't cut these rates any lower, all we can do is print money and it causes inflation. That's the end of the parade. So with our strategy, we can float in the bubble, we can safely generate profits, and when these crises hit, the put options kick in, either the TLT or the SPY rallies, and it allows us to make these safe, consistent profits.
Yeah, I've had customers ask, what it feels like, once you have your portfolio balanced, and basically, you basically put yourself into a vault, is how I like to explain it, because when you put on your option collar, you're going to add another level of defense to your fort. Okay, so let's just, I guess the easiest way to look at it is, number one, we take a defensive outlook to our portfolio. Okay, where we're almost majority of our allocation is to risk off. Okay, and then we take another level of defense to our fort. Okay, by wrapping an option call around it. So think of, you already have your fort, it's set up, right? It's pretty strong, but now you just added a steel vault outside of your fort, right? That puts you in that parameter, and you cannot go outside of it physically or mathematically. It doesn't matter if World War III starts after you're in the trade, because of the way we engineer not only the portfolio but the options on top of that. Okay, so we put you into a steel vault, and there's no way to get outside of that parameter. It's just not possible. Okay.
Now, let me ask you this, Mike. What kind of income are you trying to generate? Would 1% a month make you happy? Because we realize, not everybody wants to make 1% a month. Our product has grown from, think about it, we went from a no track record starting December and built a business revolving around giving out the trade alerts, proving it works, promising investors 1% a month, no more. And now we have over 155 clients, many of which have 7 figures following the trades. There's probably at least $20 million following these trade alerts every week, maybe more. A lot of people have a lot of money and they're quiet about it. But this is, in general, something that's been very attractive to larger portfolios who appreciate capital preservation and protection over speculation. And so if you're aiming for 1% a month and you have a long-term outlook for wanting to do this for the rest of your retirement, then I think you're going to be a happy camper in our program, and we'd love to have you. Would you like Dean to give you a call after the webinar, Mike? Okay, great. Let's see, we still have a few people on there. Let me see. Kate, are you happy making 1% a month? Or is that not exciting to you?
No, I'm not happy, but I'm not making anything.
So do you think it would be worth it to find an advisory that can protect your capital and average 1% a month? Do you think that would make enough for it to be worth your time?
Yes.
Okay. Now let me ask you this, Kate. What's holding you back? No, don't worry about hurting my feelings. What questions do you have? What skepticisms do you have? I realize I'm much younger. I don't have a 10-year track record. What is holding you back from trying the program out right now? Because like I said, I want to point out, imagine jumping into this industry. My history was finding people who had 10, 20, 30, 40 years of experience. They managed huge hedge funds. They'd made people millions of dollars in their professional life. They're touting 20, 30, 40% a year returns at a minimum. And it was only after managing these gurus over the last decade that I realized that's not what the market needs. That's not what investors need. And so I came out with this product. I said, here's what people need. Maybe not what they want, but this is what they really need. And instead of going out there with these crazy sales letters, taking your money up front, hiding all the trade alerts in the back door, I can tell you what happens with these other advisories. They have refund rates around 60%. So these people come in, they don't know what the hell they're going to get. They don't get the results of the guru because it's not organized in a way that's easy to follow. We talked about some of the problems. Number one, you don't know when the trade alert's going to come out. 2, you don't know how much money to put in the trades. 3, they're not always very honest about the trades they are putting out. And so the result is you have this huge discrepancy where the guru is doing great, but everybody else is doing totally crappy. And so the whole goal of this product was to throw everything that I've seen in the last 10 years of this completely out the window. We got rid of the sales letter. We stopped taking people's money up front. And I'll tell you what, we've only had one refund in 11 months out of 155 clients. And it's working. It's absolutely working. We have a program where I can get my members on a webinar any day of the week, and they will be happy to say, I'm getting the same result as you. We're presenting the data every day. Sometimes we're losing, sometimes we're winning. But regardless, our clients are getting on board, hopping in the webinars with big fat smiles, and they're telling me I'm getting the same result as you. Now, of course, they're more happy when we're in a period of winning. And most of the time we win. This whole thing is designed to have an extremely high win rate. The catch is we're not going to win a whole lot. We're only trying to achieve a 1% return per month. And so in the last 11 months, we've done this. We've been able to grow this company from a 0-month track record with no clients to an 11-month track record where we've made money in 10 out of 11 months. And we have over 155 clients following the program, many of which now have 7 figures following these trades. So we've got people who have been very smart in terms of being able to increase their portfolio over the last several decades, and they realize, wow, I've been very lucky. I understand we're at the end of the rope for this bull market, and now they want to really play it safe and protect capital. So knowing that's where you know who you're dealing with, Kate, what would you say is your biggest concern right now?
It's just the cost of the program.
Oh, just the cost of the program?
Mm-hmm.
Now, let me ask you this. How many are you going to be able to build this portfolio once over, twice over, 3 times over?
Not really. Not really.
So, Kate, what Jason's trying to ask you is, would you have at least the 75K to build the model portfolio that we have here?
Yeah, I can do that.
Okay. Could you do another? So let's say that's one tranche at 75K. Could you afford to build 2 tranches?
No.
Okay. Okay.
Now, keep in mind this, Kate, your broker will give you 2-to-1 buying power. So you could actually be doing double this.
Not in IRA. I don't think they do.
Oh, yeah, you're going to use your IRA. Okay. Well, you might want to consider, where's your IRA at anyways? I'm just curious. Is it at
TD Ameritrade.
Oh, man, TD Ameritrade is perfect for following our program. Well, Kate, if you want, we could have Dean give you a call because we have 2 packages. We have, I'll pull up the pricing so you guys can see what we're looking at. We have 2 good offers for you. And what a lot of people do is they'll come in on an annual rate, and then after they've made enough money, they like to upgrade to a lifetime membership. And then you look at it this way, wow, now I've paid a one-time lifetime membership, and I don't have to pay any more bills, but I continue to make income for years and years to come. So the $2,000 light product doesn't have the SPY trade, and so it's actually going to generate a higher return with a little more risk. So it's funny that most of our clients are paying us to help them take the risk out of the market, and they actually want to make less. Most of our clients would rather make 1% a month with less risk than they would rather make, say, 1.35% a month with extra risk. And so you'll find the bigger the portfolio, the more attracted they are to low volatility strategies, which is what we have to offer. So if you wanted to just start off with the light package, trading Tuesday, Thursday, that might be perfect for you with a $75,000 portfolio because you'd be able to follow a slightly different allocation. So you'd only be trading emerging markets and the TLT. So a lot of people do like that package. And let's say in 6 months you've done really well with the program. You don't want to ever pay an annual bill. We will deduct your initial payment from a lifetime package. So we can take care of that. So if you think about that, if we get anywhere close to our target return, it only takes a couple of months to pay for the program. Now on the full program where we're trading Monday through Friday, it's slightly higher priced. But again, you're paying for the dramatically less volatility. And you can only achieve extremely low volatility by taking advantage of the 3 option expirations a week. There's just no ETF in the world that does have 3 option expirations a week, Monday, Wednesday, and Friday. So most clients who do have a much larger portfolio are trading with the full program because it does reduce the volatility. So yeah, Ron, so yeah, tell us what you're doing with your 10 grand in the option. I just want to make sure you don't go do something silly. What are you doing? Spreads with it, or what are you trying to do? Let's see, we still have a few other folks on here. We have Marvino Hill, would love to hear from you. Where are you at, Marvino? Have you started following any of the trades? And Mike Mason, are you following the trades currently, or where are you at with your decision on our program so far? Okay, thanks, Mike. We'll have Dean get a hold of you and see if we can't get you joining the team here. Wednesdays are our paid webinar, so you can join the paid group next week if you do decide to join us. And I appreciate your time today. Thank you so much.
Yeah, thank you, Mike. Appreciate it. I'll be reaching out.
Okay, so Ron, so the iron condors, those are, I had a guy sold those for quite some time. And here's the catch. You sit there and you make a lot of money. You make a high return very consistently, okay? So we're talking maybe 20, 30% return on the capital at risk, okay? High probability. But then what happens when you lose because of a big move, either up or down, you know, either direction, either something good or bad happens, and you walk away with a 70% loss. And so now you have to be accurate over 66% of the time, and it's a dangerous game. So I've definitely seen that in action, and it's fun, but what you're going to learn is you're going to take a big loss, and then all of a sudden you're going to get very shy about position size. So that strategy is really fun on paper, and it's really fun most of the time until you get unusual activity. And then the second you get that, those things lose so much money that you become shy. Now you're taking less risk, and that's typically what happens. You get really confident, grow your risk on those strategies, and then you get blown out. And then you become shy, you take small amounts of risk, do that for a while, you're getting confident again, now you're increasing position size and you get blown out. And that's why I hate those types of strategies. I would much rather simply own the asset. Yeah, I would much rather just own the asset and sell a covered call. It's so much smarter. So for you, Ron, what I would suggest is to absolutely stop doing that. It's complete nonsense. I'm assuming you're going into retirement. That's a game for youngsters who can afford big losses, who have a job to replace the losses. If you were to follow our program with 10 grand, you would just follow the emerging markets and the TLT. And so you need to get up to about 15. Could you get 15 in your portfolio? Because if you had 15, you'd be able to do our light program on the Tuesday, Thursday, and actually do a trading strategy that works, that works a long time and consistently without risk of taking on huge losses. So I think if you could get 15 into your account, you'd actually be really happy. Let me pull up that slide. I'll just rebuild it really quick. Here's what we have for our light recommendation. Is right here. So you can simplify our strategy, get very similar results with only 2 trading days a week. And because your broker, so think about it. We don't want our cash earning negative 2% a year. Right now is the time to borrow. Rates are super cheap. So your broker will actually lend you money at extremely low rates right now. And so with $15,000, you can build this portfolio right here and follow the full Tuesday, Thursday trade, which has the exact same risk profile as our full program. Now the catch is emerging markets is more volatile, has more upside potential and more downside risk. But if I pull up that Tuesday trade alert, it is our best returning asset to date. And so let me pull that up just so you guys can see that.
And the other thing is to you basically take a risk profile of you know, iron condors is, you know, really on a 1 to 10, you're probably looking at a 7, maybe 8, and put yourself into a strategy. And you know, Jason says it's higher risk profile to do Tuesday, Thursday, but really on a 1 to 10 scale with the way you're balanced, I mean, it's probably more of a 1.5. And so really it's about protecting and growing your money in the most defensive manner possible instead of just going completely offensive and not having any protection whatsoever to the downside. That's a difference. That's a major difference, basically.
Yeah, so our Tuesday portfolio has done well. In December, it did lose 4%, but hey, the S&P 500 lost 16. May and July, it did very well. We lost 1.3. But I mean, think about it. If you were to go all in with your iron condor strategy with 10 grand, you could walk away with a $7,000 loss on a single trade. Now, I know you're probably not doing that, which is probably good. But on the other hand, now you can't put most of your money to work because you're too timid because you know the risk is outrageous. So that's why the strategy makes so much more sense. You get the stocks and the bonds protecting one another. You add in the option caller. Now a really bad day, a really bad month, when you combine the two, you lose 1% versus losing 20, 30, 40, 50, you know. With an iron condor, it's literally a 70% loss when you're wrong. How have you've been betting up, Ron, on the, I mean, man, the market's been, how long have you been doing your iron condors now? It's been a pretty volatile market. I'd be surprised if you've done, if you haven't had a few of those nasty spills, which is probably why you're on here. Learn about the boring 1% a month strategy. All right, let's see. So Kate has her IRA. She's in cash, losing buying power, but not at the risk of a stock or bond market meltdown. So it's good on one side, but not good that you're losing your buying power. Ron is trading iron condors. Are you in a cash account, an IRA account? You've had 2 drawdowns, yep. Cash account. Now, do you have an IRA to play with too, Ron, or are you just trying to build up? See, what happens to people is they end up in, towards the end of their life, they realize they haven't saved enough. So they start looking for very aggressive strategies, and they want to quickly grow their portfolio. And that's where they get in trouble, trying to make up lost time. So, yeah, cash count. So yeah, Ron, if you do decide you want to follow us, I would urge you to get another $5,000 in your account, figure out how to do it, and then get the light program, and then do the Tuesday, Thursday trade. I think you're going to be a lot happier. I'd hate to see you lose a couple grand in the next few weeks and then not be able to get to that 15K level. So keep that in mind if you do want to join us. Also, I do want to point out there are other aspects of the portfolio to follow that don't require so much. Yeah, that's correct, Ron. But we could give you like a quarterly price point if you want to come in and break it into 4 payments here. Do you want Dean to give you a call, see if we could work something out after the webinar? But I do want to point out, we do also play the precious metals and crypto portfolio. I don't even try to, I actually try to downplay these returns because they are very strong. But this is also part of the portfolio you can follow that's included in the service. So our returns in the precious metals and cryptocurrencies have been very strong. And again, it is with a much smaller part of our portfolio. So I spend the least time possible looking at that. But it is something that we're very in tune with in terms of. Okay, sounds good, Ron. Yeah, that sounds great. Just don't go lose half of your account so you can't get to 15 till next year. Just kidding. I wish you the best luck with those iron condors. And keep in mind, this webinar is every Thursday, so I'd love to see you next week too. Give me an update on your iron condors. All right, let's see. We still have, I haven't heard from Mike or Marvino. Are you guys still there? You have any questions? Do you see your chat box if you wanted to chat?
Yeah, I understand that side, Ron. I still do some more of the risky trading myself, and I find myself getting up at 3 in the morning, and every time I do it, I just tell myself, why don't I just put more money behind this program and stop the risky stuff.
It feels great when you win, but it feels much worse when you lose.
Yeah.
But it only takes a couple of years of that before you finally learn the lesson the hard way. All right, guys. Well, hey, Kate, I'm going to have Dean give you a call, see if we can't get you having fun with us instead of just watching the webinars. And if not, we'll hopefully see you next Thursday. Marvino, Mike, Ron.
Okay.
Thank you for joining us, Kate. I'll reach out to you in a little bit, okay?
Okay.
Oh, I heard one more voice out there. I'm not sure who that was, but.
Kate hopped in for just a second, Jason.
Okay, great.
And then Ron said, thank you for the presentation.
Okay, great. Well, hey, we really appreciate everyone's time. And you guys stuck in there for 2 hours, so good for you. Hopefully you learned a few things. And if nothing else, you're prepared for the reversal of interest rates over the next couple, hopefully not decade and a half, but it could be that long. So if nothing else, you know what to look out for. You realize we're in a big market bubble, and you can see how to play it safe. So thanks again for your time, and join us again next Thursday.
Thanks, Jason.
Thanks, Dean.
Bye, Ron. Thanks for coming in.